Imagine you're out on a date and the conversation turns to investing or global markets. Wouldn't it be impressive to confidently drop some Forex lingo? Just like learning any new skill, mastering the language of Forex can set you apart and even win someone's heart. In this video, we'll walk you through the essential Forex terms every beginner should know before making their first trade. Whether you're aiming to impress or just want to feel more confident, knowing these terms will give you a solid foundation. Let's start with the basics and build up your Forex vocabulary step by step. The world of Forex, currencies are grouped into majors, minors, and exotics. Major currencies are the most traded and come from countries with large, stable economies. Think of the US dollar, euro, yen, and a few others. These are called the majors. They're highly liquid and widely accepted. Minor currencies, on the other hand, are from smaller or emerging economies. They're still traded in significant volumes but are less liquid than the majors. Then there are exotic currencies, which are even less liquid and more volatile, often coming from developing markets. Understanding these groups helps you navigate the Forex market with confidence. Let's break down a currency pair. The first currency listed is called the base currency. It's the reference point for the pair, showing how much it's worth compared to the second currency. For example, if you see USD CHF at 1.635, it means 1 US dollar equals 1.635 Swiss francs. In most cases, the US dollar is the base currency, but there are exceptions like the British pound, euro, and a few others. Knowing which is the base currency is crucial for understanding quotes and making informed trades. Next up is the quote currency, which is the second currency in any pair. Sometimes called the pip currency, it's the one you use to measure profit or loss. For example, in EUR/USD, the USD is the quote currency. Any changes in your trade's value are expressed in this currency. It's important to keep this in mind, especially when calculating gains or losses after a trade. Mastering this distinction will help you read Forex quotes like a pro. Pip is the smallest unit of price movement in Forex trading. Most currency pairs are quoted to 4 decimal places, and a pip is the change in the fourth decimal. For example, if EUR/USD moves from 1.2538 to 1.2539, that's a 1 pip move. For pairs involving the Japanese yen, a pip is the change in the second decimal place. Understanding pips is vital because they're the building blocks of profit and loss calculations in Forex. Brokers offer even more precision by quoting prices to 5 decimal places. This is where pipettes come in. A pipette is 1/10 of a pip. For example, if EUR/USD moves from 1.23456 to 1.23457, that's a 1 pipette move. Pipettes allow for more accurate entry and exit points, which can be especially useful for high-frequency traders who need to capture every tiny movement in the market. Thanks for watching. Make sure you like, subscribe, and comment to this video. If you need the full course, check the link on my bio. Bid price is the rate at which the market is willing to buy a specific currency pair. As a trader, this is the price at which you can sell the base currency. It's always shown on the left side of a quote. For example, if GBP/USD's quote is 1.881215, the bid price is 1.8812. This means you can sell 1 British pound for 1.8812 US dollars. Knowing the bid price helps you understand where you can enter or exit a trade. The flip side, the ask or offer price, is the rate at which the market is willing to sell a currency pair. This is the price you pay to buy the base currency, and it's shown on the right side of the quote. For example, if EUR/USD is quoted at 1.281215, the ask price is 1.2815. This tells you how much you'll pay to buy 1 euro. The ask price is also known as the offer price, and it's crucial for planning your trade. Difference between the bid and ask price is called the spread. This spread is essentially the cost of making a trade. For example, if USD/JPY is quoted at 118.311834, the spread is 0.04 or 4 pips. Dealers sometimes refer to the main digits as the big figure quote, often omitting them when quoting rates verbally. Understanding the spread helps you gauge transaction costs and market liquidity. Forex quotes follow a standard convention. Base currency quote currency equals bid/ask. For example, if EUR/USD is quoted as 1.23451237, EUR is the base, USD is the quote, 1.2345 is the bid, and 1.2347 is the ask. The spread here is 0.0002 or 2 pips. Knowing this format makes it much easier to read and interpret Forex quotes, ensuring you always know what you're looking at. Bid-ask spread isn't just a number, it's the transaction cost for a round-turn trade. A round-turn means you buy and then sell, or vice versa, the same amount in the same currency pair. For example, if EUR/USD is quoted at 1.281215, the transaction cost is 3 pips. The formula is simple. Transaction cost equals ask price minus bid price. Keeping an eye on transaction costs helps you manage your trading expenses and maximize profit. Cross-currency pair is any pair that doesn't include the US dollar. These pairs can behave unpredictably because trading them often means you're effectively making 2 trades involving the dollar. For example, buying EUR/GBP is like buying EUR/USD and selling GBP/USD. Cross-currency pairs often have higher transaction costs and can be more volatile, so it's important to understand their unique dynamics before trading them. If you open a Forex trading account, you'll need to deposit a minimum amount. This is your margin. Each time you make a trade, a portion of your account is set aside as the initial margin requirement. The amount depends on the currency pair, its price, and the lot size. For example, with a 200:1 leverage and a mini lot of $10,000, you only need $50 as margin. Understanding margin requirements helps you manage your risk and avoid unwanted surprises. Leverage lets you control a large position with a relatively small amount of capital. It's expressed as a ratio like 200:1, meaning you can control $200 for every $1 you deposit. Leverage varies by broker and can range from 2:1 up to 500:1. While leverage can amplify profits, it also increases risk, so it's important to use it wisely and understand how it affects your trades. Now that you've learned the essential Forex lingo, you're ready to impress anyone with your knowledge. From understanding major and minor currencies to calculating pips, spreads, and transaction costs, you have the vocabulary to navigate the Forex market confidently. Remember, mastering these terms is just the beginning. The more you practice, the more fluent you'll become in the language of Forex. So next time you're on a date or chatting with friends, you'll have the confidence to speak like a true Forex insider.